I've already started reducing my exposure and shifting more capital toward junior mining companies. I believe that, looking ahead to this year, and quite possibly the next 6 months, the most undervalued asset on Earth right now, especially relative to the metals they extract, is gold and silver mining stocks. They're practically given away compared to their historical norms. OG John AG checking in, January 28, 2026. Stats indicate around 80% of you tuning in aren't subscribed yet. If this no-nonsense insight is helping sharpen your perspective on metals and the broader macro picture, go ahead and hit subscribe. If it's not delivering genuine value, skip it. No hard feelings. Plenty of conventional outlets are out there pushing the stories they prefer you to accept. This space is different. We dive into the details they'd rather keep under wraps. One quick note. I'm active over on X, formerly Twitter, call it what you will. If you haven't followed me there already, you're missing out on live chart updates, real-time vault movements, COMEX data releases that rarely hit YouTube. Links are in the description. Follow along now because I'm gearing up to unleash some serious tools from my toolkit, and you'll want to be connected before the crowd catches on. Now let me share what just unfolded, because I went back and verified these figures multiple times before recording. Gold finished above $5,100 on Monday. Right now, as I speak, it's trading around $5,275 per ounce, all-time record territory. Silver is sitting at $114. Those are the actual levels. I'm pulling them straight from TradingView, just like you can. And here's the wild part. While gold is shattering records and reaching the highest nominal price ever seen in history, one of the most respected analysts in the precious metals arena has publicly detailed why he's discreetly trimming leveraged bets and channeling funds into gold and silver mining equities. His logic? They're outrageously undervalued, historically and statistically, relative to the metals coming out of the mines. Plus, the charts are signaling a major breakout. Pause and absorb that. Gold at peak levels ever, yet miners priced as though the metals barely budged. We're diving deep into the metrics, historical benchmarks, technical patterns, the silver miner situation in particular, and why this pricing mismatch could represent one of the biggest chances, or potential pitfalls, in the precious metals landscape today. This isn't excitement, it's backed by facts. Let's dive in. The heart of the problem is this. The XAU index, the Philadelphia Gold and Silver Index, which follows leading precious metals mining firms, is now trading at just 4% to 8% of the value of 1 ounce of gold. 4 to 8%. If you're unfamiliar with this metric, it might not click yet. Let me provide perspective. In the 1980s gold bull market, miners typically traded at about 25% of the gold price. The same pattern held in the 1990s and during the 2000-2008 surge. 25% was the typical historical norm. Today, we're stuck at 4 to 8%. That puts miners at roughly 1/5 to 1/3 of their usual valuation compared to the commodity they produce. You're essentially acquiring a business that mines gold, refines it, and sells at $5,275 per ounce, yet the market prices it as if gold were worth far less. That's the massive gap at play. Why does this go beyond a quirky statistic? Because ratios like this eventually mean revert, and when they do, the money flows are huge. We're not discussing modest 10 to 20% gains in miners. We're potentially looking at multiples. If the XAU to gold ratio climbs just halfway toward its long-term average, miners could double or triple even if gold holds steady. Should gold keep climbing during that normalization, the upside becomes explosive. Tying it together is the technical angle. The XAU to gold ratio has lingered in an ultra-depressed range for 11 full years. That's not merely a pullback or bear phase. It's an entire era where investors haven't witnessed miners deliver the kind of performance seen in earlier cycles. Right now, we're testing and pushing above that long-standing resistance around 8%. A solid breakout from this level has, in the past, sparked enormous inflows into the mining industry. Institutional capital, trend followers, retail enthusiasm, everything. This isn't some random line sketched on a personal chart. It's an 11-year consolidation backed by massive volume data. When price compresses for over a decade and then surges out, the pattern points to a regime change. The key uncertainty is whether this move sustains or turns out to be another fake-out, as occurred several times since 2013. Let's zoom in on silver miners, where the leverage intensifies even further. When comparing silver-centric producers to gold miners in terms of relative performance, the opportunity looks even stronger. Silver is at $114, sharply higher than recent levels. But silver mining stocks haven't yet seen the same revaluation that gold miners are beginning to experience. This is crucial because silver producers possess far greater operational leverage to silver prices than gold miners do to gold. A 10% increase in silver can drive 30%, 40%, or even 50% swings in earnings and cash flow for silver-focused operations based on their cost profiles. With silver now at 114 and industrial consumption ramping up, these companies are valued as though silver remains in a much lower range. If silver pushes to 120, 130, or 140 in the coming 6 to 12 months, silver miners are positioned to significantly outpace gold miners. That's pure mathematics. Elevated margins, amplified leverage, similar starting market caps, leading to outsized percentage returns. And here's what a highly experienced analyst recently stated openly. I've already begun scaling back my holdings and reallocating toward junior miners. I'm leaning more toward unleveraged mining equities for the balance of this year and probably into the next. That's where the greatest value emerges. This comes from someone who manages substantial positions, grasps market dynamics, and has years in the game. He's deliberately pivoting away from leverage and into the stocks. That shift speaks volumes about his view on the bull market's next leg. That said, let's hit pause and keep it balanced. I'm not pushing a purely optimistic narrative. There are legitimate explanations for why miners lagged for 11 years, and those factors don't vanish simply from breaking a chart level. Here's the cautious side you need to weigh. First, business risks. Miners are operating companies with expenses, workforce challenges, regulatory hurdles, permitting setbacks, and geopolitical exposures where governments might alter taxes or seize assets suddenly. Owning physical gold or silver means direct possession of the asset. Owning a miner means holding a firm attempting to extract it profitably. Those are distinct risk categories. Second, stock market correlation. Miners behave like equities. In a broad equity downturn, liquidity crunch, or risk-averse macro event, miners can plunge, even as metals rise. March 2020 illustrated this. Gold and silver dipped briefly, but miners suffered far worse due to their equity-like sensitivity. Third, share dilution and poor capital use. Mining firms have a track record of issuing equity at inopportune moments, overpaying for deals, exceeding project budgets, and eroding shareholder value even amid commodity rallies. Selectivity is essential. Not every operator is skilled at capital deployment. Some excel, others falter. Entering this area demands thorough research on leadership history, financial health, and project quality. Fourth, breakout failure risk. We've encountered phony breakouts in the XAU to gold ratio previously. In 2016 and 2020, miners surged, the ratio jumped, then reverted sharply. If history repeats with another false signal, losses could mount even while metals grind upward. The chart looks promising currently, but technicals offer odds, not guarantees. Fifth, the 11-year low base has roots. Investors suffered major losses, institutions exited, and trust eroded. Rebuilding credibility requires consistent results and evidence that conditions have truly evolved before large-scale capital returns. Until then, being early can equate to being incorrect in market terms. Those are the downsides, the grounds for caution, and why this isn't an effortless win. On the flip side, the bullish argument intensifies beyond the technical signal. Gold at $5,275 isn't driven by fleeting speculation or retail frenzy. It's a fundamental macro adjustment fueled by ongoing central bank acquisitions, geopolitical divisions, worries over currency erosion, and a lasting change in reserve asset perceptions. World Gold Council figures confirm central banks as consistent net buyers at rates unseen since the 1970s, and momentum appears to be building. Silver at 114 draws strength from industrial forces. Solar panel growth is surging worldwide. EV manufacturing is accelerating. AI servers demand substantial silver for electronics and heat dissipation. 5G networks, defense uses, nuclear energy, all consume silver heavily. Silver Institute reports highlight persistent structural deficits. Consumption exceeds production. Inventories are shrinking. This is a lasting pattern, not a short-term fluctuation. Thus, gold rises due to monetary drivers, silver due to industrial ones. Yet the firms producing them trade as if it's still 2013. Such a disparity can't endure forever. Here's the pivotal insight that reframes our entire discussion. Miners stayed depressed for so long, largely because confidence in the bull market was lacking. Each metal rally felt fleeting. Each spike in silver seemed doomed to reverse. The trauma from the 2011 peak and ensuing crash lingered so deeply that institutions avoided miners even as prices recovered. But the dynamic shifted in recent months. Gold isn't merely hitting new highs, it's doing so alongside silver making new highs too. That dual strength hasn't persisted meaningfully since the early 2000s. When monetary and industrial narratives align and both metals advance together, miners historically awaken. It transitions from isolated trades to a genuine trend, and trends draw capital. The analyst moving into miners isn't betting on one strong earnings period. He anticipates the early phase of a prolonged sector revaluation, from overlooked and deeply discounted to widely followed and richly priced. He aims to establish positions ahead of that influx. For positioning, if you're focused on physical holdings, stick to your strategy. Accumulate, retain, prioritize security. Physical serves as protection and long-term store of value, the core base. But if you're seeking amplified returns, asymmetric potential, or tactical plays around a foundation, mining stocks now merit consideration in ways unseen for years. Approach intelligently. Spread across producers, prioritize strong jurisdictions, solid management, healthy finances. Size appropriately, use stops if trading, recognize the volatility and high-risk, high-reward nature. This isn't set-it-and-forget-it indexing. It's hands-on, strategic, and effort-intensive. If analyzing individual miners isn't feasible, perhaps skip it. Stay with physical, opt for broad ETFs, or simply hold metals. No judgment, know your strengths. Yet if you possess the knowledge, tolerance for swings, and discipline, with miners at 4 to 8% of gold's price, an 11-year base possibly breaking higher, both metals in confirmed uptrends, and astute capital rotating in, this could rank among the premier setups in precious metals over the past decade plus. What I'm monitoring closely next. Can the XAU to gold ratio sustain above 8% for weeks? If confirmed with volume, it signals institutions returning. Silver's outperformance versus gold would confirm robust industrial pull. COMEX stockpile trends for tightness hints. Macro signals on central bank buying pace or silver demand peaks. And company-specific updates, earnings, output forecasts, capital decisions. Because even stellar metal markets won't rescue weak operators. In summary, gold and silver miners aren't merely inexpensive. They're among the most undervalued in generations relative to the resources they extract. The technical picture suggests a possible sharp breakout that could pull in massive capital. Fundamentals, monetary for gold, industrial for silver, underpin elevated metal prices, with informed investors already shifting toward the sector. But nothing is assured. Risks abound. This demands research, awareness of hazards, proper sizing, contingency plans for failure or success. The potential exists. The perils exist. Your approach determines the outcome. I'm simply presenting the evidence, linking the elements, and enabling your own educated choice. Your money, your decisions, your accountability. Remain alert, question everything, maintain control. Trade with reason, not emotion.